CNBC just called XRP the hottest trade of 2026, ahead of Bitcoin and Ethereum. And instead of pumping, XRP slipped about 5%. That confuses a lot of people, because most investors assume bullish headlines should instantly push price higher. But markets don't work that way, and XRP especially doesn't. Today, I want to explain why XRP actually fell on bullish news, and what that reaction really tells us about how this market is behaving. The story comes from CoinDesk, reporting that CNBC described XRP as the hottest trade of 2026, even placing it ahead of Bitcoin and Ether in terms of narrative momentum. At the same time, price slipped roughly 5%. That combination is important, because it shows a disconnect between media excitement and market behavior. And that disconnect is exactly where most misunderstandings begin. Here's the first thing to understand. Media outlets describe trends. They don't create demand. When CNBC labels something the hottest trade, they're reacting to interest that already exists. They're not signaling fresh capital entering the market. Institutions don't allocate because of headlines. Algorithms don't buy because of commentary. And professional traders rarely chase news after it's already public. So when a headline lands, the market often does nothing, or the opposite of what people expect. XRP doesn't trade like Bitcoin. Bitcoin often reacts to macro news, interest rates, ETFs, risk sentiment. Ethereum reacts to ecosystem changes, upgrades, network activity. XRP trades on structure, liquidity, and timing. That means XRP can look quiet, stubborn, or even weak, right when narrative sounds strongest. This isn't a flaw. It's a different market profile. A price dip after bullish coverage usually means one of three things. First, short-term traders took profits into the news. Second, the market had already priced in the narrative. Third, larger participants are waiting, not reacting. None of those are bearish signals on their own. In fact, this kind of reaction often shows discipline, not weakness. Let's put the 5% move in perspective. In crypto, that's noise, not a breakdown. There was no structural failure, no liquidity collapse, no invalidation of higher time-frame trends. It was a reaction, not a rejection. And those two things are very different. Here's something most people don't realize. When an asset gets labeled the hottest trade, it attracts late attention, not early capital. That attention often arrives after positioning has already occurred. So instead of fresh buying, you get hesitation, rotation, consolidation. Again, not bearish, just inefficient timing. XRP doesn't move because people talk about it. It moves when liquidity conditions shift large players, reposition real demand appears in the market. Those things don't announce themselves with headlines. They show up quietly, in volume, structure, and follow-through. That's why XRP often moves after the noise, not during it. The mistake most investors make is confusing narrative with timing. Narratives explain why an asset matters. Markets decide when it moves. If you understand that difference, moments like this stop being confusing and start being informative. So yes, CNBC calling XRP the hottest trade of 2026 is notable, but the short-term dip doesn't contradict that idea. It actually reinforces how differently XRP behaves compared to hype-driven assets. This wasn't a failure. It was a reminder. In markets like this, patience beats prediction, and structure matters more than headlines.